industrial mining goes downhill. It goes into recession when the economy cuts back. And so silver production from really about half of the new source of silver also gets cut back. And so that's why I think that if the gold-silver ratio is indeed an indicator of recession, economic contraction here, that's the reason why you see the gold-silver ratio very often, once it peaks, it reverses course very quickly in the other direction.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for May 12th through May 19th, 2025, while supplies last. First this week, we feature backdated 1-ounce gold American Eagles at just $89.99 over spot per ounce. 1-ounce 2025 silver American Eagles are just $4.99 over spot. Next, we have 10-ounce silver Royal Mint coins at just $2.99 over spot per ounce. The 10-ounce Britannia, 10-ounce Royal Arms, 10-ounce Little John, and 10-ounce Merlin are all 4.9s fine. And we have a very limited quantity. Again, they're just $2.99 over spot per ounce while supplies last. Next, backdated 1-ounce gold Canadian maples are only $69.99 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. With us today for the first time is Mark Thornton, a senior fellow at the Mises Institute. Mark, thank you so much for joining us today.
Elijah, it's great to be on your program.
Well, it's great to have you today. I did want to discuss one of your recent videos. I'll put a link in the description of this video to a playlist of many of the YouTube videos you've been producing recently. And one of the latest ones was on the gold-silver ratio. And this is something that has caught my attention recently as well, with the gold-silver ratio around 100 to 1. We've almost never seen this before. It was only one other time in history, back in 2020, where we saw this, the gold-silver ratio above 100 to 1. Your take on that, and what are some of the steps that maybe some investors should be thinking of right now?
Yeah, Elijah, I think it is historically important that gold has been so strong in the marketplace, and silver's been lagging. I know a lot of people complain about silver, but silver's up significantly as well. It's just that gold has been doing so well, I guess primarily because of central bank buying of gold. But the gold-silver ratio is a big indicator of telling us what's more expensive and what's less expensive. And the idea that, the gold-silver ratio is over 100, meaning that for 1 ounce of gold is equivalent to more than 100 ounces of silver. That just doesn't happen. I mean, historically, the old ratios were 10 to 1, 15 to 1. In the modern era, it's been averaging more like 50 or 60 to 1. So the idea that it's over 100 to 1, I think is historically important. And it's also an economic indicator. Obviously, both metals are doing extremely well. Both metals have been moving up now for multiple years. And so I took notice of the gold-silver ratio getting over 100. It's still about 100. And so I started looking at that. And one of the things that I found was that very often that very high ratio is associated with a looming recession. But also I stumbled onto the notion, the investor notion that not only is gold very expensive, but that it might be a good time to switch from gold to silver. And so I did a couple of experiments. I traded some electronic gold for some silver gold, and then I actually traded a gold coin for silver rounds, just to go through the process, see what it was like, see if there was any surprises in the whole thing, because I think it's a from an investor's point of view, from my personal point of view, it's a really good deal.
Definitely. And I think a lot of my clients have been thinking about doing similar things and have done similar things of changing gold to silver. And in my view, it seems like a very good deal right now. Some people are skeptical, though, and are saying, well, maybe this is just a new norm, right? You have central banks buying gold. They're not really buying silver. And so this might just be kind of the new normal for the gold-silver ratio. And we could see the gold-silver ratio increase significantly from here. Your perspective on that argument?
Well, I mean, that's a possibility. It could be a new normal, and the gold-silver ratio could go to 110 or 120, and I would probably switch even more rather than less. And so it could go ever higher. I think it's been as high as 120 at one point, but that was a very short period of time. And, that's, once you get past economic theory, the idea that the government's spending, it's borrowing, it's going to have to print, and therefore precious metals, real money, is going to be valued higher in terms of the fiat paper money. Once you get past that, you're more or less, you have to rely on historical information. That's what all forecasters are relying on. That's what every indicator relies on, is historical past experience. I've never come across any indicator, even the Super Bowl indicator, financial information indicators. That's all past data. That's all history. That's all we have to work on once we get past theory. And, that's one of the things they teach us as an Austrian economist, is that we don't know when things are going to happen. We don't know how much things are going to change, what the numbers are actually going to be. We can't actually forecast in a very precise way. And that's why everybody must rely on historical information, play the odds. I'm a value-oriented person, and that seemed to make a lot of sense to me. And of course, I also don't go all in on everything, with all my money or with all my, perspective on something. I do, balance the odds and have a careful outlook on what's going to happen in the future. So yes, the gold-silver ratio could go even higher, but based on everything we know and what we can rely on, the gold-silver ratio is at a high point, and those things tend to turn around very quickly, and there's a good reason for that. I did a podcast episode on the silver lining, why silver behaves the way it does. Why does it seem to catch up? Well, the reason, theoretically, and in fact, is that when we go into a recession, that's when gold tends to reach its relative peak, and that's when silver tends to catch up. The wild dog catches up with the mama dog, in a sense, and then surpasses it. And why is that the case? Well, about half of all silver mining comes from, and remember, silver is something that, is mined, it comes to the surface and it's put to use, by and large. Whereas gold, it comes to the surface and it stays in use. It's not disposable in any sense. So with mining silver, 50% of all silver comes from industrial mining. And so industrial mining goes downhill. It goes into a recession when the economy cuts back. And so silver production from really about half of the new source of silver also gets cut back. And so that's why I think that if the gold-silver ratio is indeed an indicator of recession, economic contraction here, that's the reason why you see the gold-silver ratio very often, once it peaks, it reverses course very quickly in the other direction. And that's the theory behind why that happens.
So it seems like if we see this reversal, or that since we're seeing this spike in the gold-silver ratio, probably a recession is coming soon. And that would align with a lot of what people are thinking out there, that maybe the tariffs or different economic indicators are showing that, a recession is imminent. Your perspective on that, are there any other signs that you're seeing that we really could see a recession later this year or at least soon?
Yeah, I'm anticipating a recession in the economy. I'm anticipating the stock market doing much poorer. We've been in a very long bull market. The unemployment rate has remained below the full employment rate level, which is a leading indicator of the economy turning around, going into a recession, and the stock market turning bearish. And so we've already got that historical background of a booming, very long-term boom in the stock market, and particularly in the NASDAQ and the technology stock, the artificial intelligence stocks, and that sort of thing. And we've had an unemployment rate very low for a number of years now. And so those are the preconditions. A boom is a precondition for the bust. And so it's perfectly logical to anticipate a bust in the economy. And this is the President Trump's tariffs. That's really beside the point. That's a different issue. Tariffs are not about inflation in the business cycle. That's either you're making yourself poor with tariffs or you're making yourself richer with free trade. So that's a separate issue entirely from the work that I do. And so, yes, I am anticipating a recession. And given that the unemployment rate has been so low for so long and the stock market has risen so high since the last bear market, I anticipate that things could be very severe. And that would, again, push the gold-silver ratio in the other direction. That would be the push off of the ledge for the gold-silver ratio to reverse course.
I'm thinking back at 2020 when we saw the gold-silver ratio above 120 to 1, and then it reversed sharply with, silver then rising. I think it was at its low $11 and went all the way up to, I think, almost 30 within a few months there. And the gold-silver ratio just plummeted at that point. But that was wasn't that still kind of within wasn't the spike down because of the recession? And then the recovery is when we saw precious metals rise? Or can you kind of maybe clarify those timeframes there of when does the recession hit and when does the gold-silver ratio peak and fall from there?
Well, the gold-silver ratio tends to peak right before a recession. And then it follows the course down through the recession and gets reversed eventually. And of course, once you go into a recession, once the stock market retreats, the Federal Reserve is going to be cutting interest rates. And my anticipation is that we're going to get several interest rate cuts once this starts to materialize. I know that the Fed officials in Wall Street, all that, they're looking for one or two cuts. I think that's wrong. I think that once the real state of the economy is revealed, the Fed is going to be forced to make a number of cuts. And the only thing that's holding them back really is the fact that interest rates and the need to finance the tremendous government deficits and the national debt is crimping their style. And we recently saw a real setback in the funding process for the federal government that kind of spooked the markets when interest rates on the 10-year bond went up unexpectedly in a jerky sort of fashion. But with respect to 2020, 2021, I think we have to take everything that occurred in that period with a grain of salt. and not try to base our analysis on that period necessarily, or try to fit our analysis to that period, because you have a very, very unusual circumstances that have never really happened before, where the government simply shuts down 1/3 of the economy, and where the government, borrows an additional $5 trillion, and where the Federal Reserve makes another $5 or $6 trillion of funding available. So everything that occurred there was so influenced by the COVID response by government that we don't want to rest our laurels. We don't want to base our analysis or our investments on what happened during that period, because that takes our eye off of the long run theoretical results that we know are true about government spending and Fed money printing and all of that. So I try to not eliminate that from my analysis, but I don't want to place too much emphasis on that as well.
Now, when it comes to your outlook then for the economy, obviously a recession hitting and probably then the Fed easing quite a bit there. You've also recently talked about the possibility of hyperinflation, and a lot of our guests are talking about this sort of possibility where we see a huge decline in the value of the dollar or a huge economic crisis. Do you anticipate, I mean, it seems like, I've been talking with guests about this kind of crisis for quite a while, and it seems like things just keep getting kicked down can't keep getting kicked down the road. Do you anticipate that this coming downturn will be the big one, so to speak? Or do you anticipate that the Fed will be able to push this down maybe a few more years?
I don't anticipate this downturn, no. I mean, the first and only time that I ever spoken about hyperinflation was in 1995. It was at a gold conference, and people were making their predictions for gold being $900 or $1,000. And I said, well, my prediction is that the price of gold will be infinity, because the value of the paper dollar will reach zero. But the time period on that can be decades and decades and decades long. And we're 30 years into that. And I think my caution on that particular prediction was correct. But I think we're very, very close. And that's why for the second time in my entire life, I talked about hyperinflation on the Minor Issues podcast a couple of weeks ago, because I think we're making that turn where we're really getting to the point where the national debt and the annual deficit in the government's budget and the ability to finance that, because right now our foreign investors have pulled back in terms of investing in government bonds pretty much across the board. And the domestic economy is also one that's not, just oozing forth with additional savings by Americans who want to buy 10 and 30-year government bonds. And so it's getting to the push against shove aspect. But the big thing about the hyperinflation of the U.S. dollar is the U.S. dollar is, a friend of mine put it this way, it's the least dirty shirt in the laundry hamper. And so it's the best paper money out there because the U.S. economy is so big and we have such an intimidating military presence. But I think now, in the past, certainly in 1995, in 1965, in 2015, the dollar was the solid world reserve currency. It was the solid world trading currency. It was the most stable of the fiat monies in the world. But I think now the U.S. is backing itself into a corner. And if there was ever a need, or even if there wasn't really much of a new need, like an emergency or a war, we're in a precarious funding situation. the interest on the national debt is now the largest outside of Social Security. I guess it's the largest single expenditure. And so the U.S. national debt is now 125% of gross domestic product. And historians have found that anytime a country gets into where their national debt is 100% of gross domestic product, it enters a spiral from which they can't get out. And so we're going to see. And I'm not happy about it. I'm very perplexed about it. I'm kind of angry about it that very few people are even talking about it. And even Secretary Bassett, kind of dismissed the idea that the U.S. lost the last of the 3 AAA bond ratings. And he kind of dismissed that as, that's Biden's fault, or, it hasn't changed anything in the last 24 hours and, things of that nature. This is a very serious problem. We're in a spiral and it's going down. We could reverse it with the right policies, but there is absolutely no indication to me that anybody in Washington, D.C. has any interest in doing anything about it. So I think we all have to be prepared that we're going to continue down the spiral. And this is essentially a toilet. This is not, some playground game spiral. This is serious business. It could mean a drastic reduction in our standard of living. It could mean various types of civil chaos, frankly, because high rates of inflation. I mean, we experienced a short period of 9% increases in the consumer price index, and it had a tremendously negative undoing in many family budgets across the country that they still haven't recovered yet. So, we're talking easily going beyond those type of levels with the tariffs, with the lower value of the U.S. dollar. It's now below, I think, the dollar index is below 100, and I anticipate that going much lower. And that means higher prices. That means that we're going to be paying more for imported goods, again, irrespective of any tariffs. And we're also going to be paying more for everything that's produced and sold on an international market, like energy, raw materials, things of that nature. Those prices are going to go up. Even if we produce them domestically, these things are set at world price levels in terms of dollars. And if the dollar goes down, those prices go up, and the impact is that our real income is going to go down. And, these things are converging, and they're all converging in a negative way. And I don't see any grip in Washington. As a matter of fact, I don't even see much of a grip or an understanding on the part of many average, normal people out there in the economy. They don't seem to even know about the situation with the national debt, the interest payments on the national debt, the consequences of the Social Security system, Medicaid and Medicare going forward. They don't seem to realize that these problems are happening because the politicians are simply not talking about it.
Do you anticipate that? Do you think that there's any way out of this? I mean, I could think of maybe some outside possibilities of, if we see tariffs really bringing in a lot of new revenue, if we, I guess, make America healthy again, right? And bring down healthcare costs. Those are ways we could gain more revenue and actually reduce government spending and maybe balance the budget. It seems like a really, really long shot in my mind, but your take on any sort of possibilities out there?
No, I mean, I've looked at that. I've looked at the idea of revenue from the tariffs. That's a non-starter. That the amount of revenue from that is going to be insignificant no matter what the tax rate is. the amount of savings from Doge is really not going to be significant enough to really reverse anything with regards to spending. So those are complete non-starters. The idea that artificial intelligence is somehow going to make us more productive and we're going to be able to grow our way out of it is also, I think, a non-starter, because if you thought of artificial intelligence and you put it into with respect to personal computing technology, cell phones, smartphone technology, the internet, all of these things, they're all great, right? They're all great human ingenuity. They're all going to do great things for the human condition. There's no question about that, but these things take time. They take, a couple of decades to really infiltrate and become integrated into the American economy. It's usually, depending on what technology you're talking about, it's usually about 2 decades. And yes, they do have very, very important in terms of productivity and efficiency. There's no question that those are going to take place, but they're not going to solve the problem of the national debt. I think it's possible, a dictator could sit down and say, okay, this is what we're going to do to phase out Social Security over the next 2 generations. This is what we're going to do to confine Medicare and Medicaid costs to, a 3% growth rate. Here's what we're going to do, to solve these problems. It can be done. It can be solved, but there's no movement in Washington, D.C. to change anything. And, Medicaid and Medicare, they have enormous lobbying organizations in the form of hospitals, pharmaceutical companies, the American Medical Association. These are the people that are making all of the money off of Medicaid and Medicare, and they have powerful lobbying groups, and they're the ones that write the rules of how all this money is being spent. And there's no way in the world they're going to let anything go. And if any politician steps forward and says, I want to cut this, they're going to scream bloody murder and saying you're taking away health care from the least advantaged members of society. Well, that's what we're going to find out about in terms of the least advantaged people in society if all of this goes unchecked in the coming years.
And this is, again, one of the great things about the Mises Institute is really promoting Austrian economics. Can you speak a little bit about Austrian economics and how it seems like Austrian economics has really predicted a lot of these problems that we face today?
Yeah, Austrian economics is the modern version of classical economics. The early Austrian economists fixed some of the problems that they had back then in terms of supply and demand, opportunity cost, comparative advantage, all of the basics of economics. So it's logical, deductive, theoretical economics that a lot of people call common sense, but it's really rigorously scientific. And it has a very long tradition back into 1870 and really going back even to like Aristotle and the medieval monks. So, it's a long-standing tradition, but we're still the smallest group of economists. We're still a very small minority. But one of the things I did in my 2018 book on the Skyscraper Curse is the second half of that book looks at those same episodes of the Skyscraper Curse, like the Great Depression, like the Panic of 1907, like the stagflation of the 1970s, and even the Great Financial Crisis. The Skyscraper Curse reared its ugly head at those points in history, but also Austrian economists stepped forward and actually predicted these crises. Now, they were not looking at skyscrapers, they were looking at the Austrian business cycle theory that was pioneered by Ludwig von Mises, Friedrich von Hayek, Murray Rothbard, and many others. And it all centers around the Federal Reserve and its interest rate setting policy, but it's been very helpful. Austrian economists have been able to make some very accurate, timely predictions about the major crises in the economy. We are not very good at predicting the short-term movements in GDP or, minor corrections and advances in stock markets or gross domestic product. But our theory does tell us when things get abnormal, when they get out of the channel, and when people need to beware and to protect against what the Federal Reserve has been doing to them unknowingly. That's another area where, 90% of Americans don't even know what the Fed is or what they're doing or how they're adversely affecting their lives and our economy, their businesses, their investments.
And what are some ways that people, I guess, first educate themselves, right? Can educate themselves on all of this. But if we take the principles of Austrian economics and really apply it to our own lives, right, and protect ourselves from, this Keynesian experiment that is out there right now, what are some practical steps that our viewers can take?
Well, I'd encourage everybody to go to our website. It's mises.org, and you can get our daily articles. I'll send you an electronic copy of my book on the Skyscraper Curse so you can see what the theory is and what Austrians have said about it over the last 100 plus years. But we have lots of free information. There's no registration. There's no membership fee that you have to pay in order to use all of our resources. And so we have, I think, 5 different podcasts. My podcast is the Minor Issues podcast, which is a weekly 8-minute podcast about something in the economy that I find interesting and important. So I would encourage everybody to touch base with us, and we'll send you some free information. I think our current free offering is Murray Rothbard's book, What Has Government Done to Our Money? And I think that's a great place to start. It's a very short, easy to read book about the history of how we went from gold and silver as money to this paper money run riot over all of our lives.
We'll put all those links in the description of this video here. We really appreciate your time today, Mark. Any last thoughts before we let you go?
Well, I think we're in for some interesting times in the next few weeks. I think this return in the stock market and this momentary lull in the gold and silver market, I think that volatility is going to be the name of the game going forward here this summer. I don't think it's going to be a sleepy summer, and so I'm ready to go, ready to fight the good fight against the Fed and the government and everything that they're trying to do to undermine the American economy and our personal economic situation.
Fantastic. Well, Dr. Mark Thornton, thank you so much for your time today, and God bless.
Thank you.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for May 12th through May 19th, 2025, while supplies last. First this week, we feature backdated 1-ounce gold American Eagles at just $89.99 over spot per ounce. 1-ounce 2025 silver American Eagles are just $4.99 over spot. Next, we have 10-ounce silver Royal Mint coins at just $2.99 over spot per ounce. The 10-ounce Britannia, 10-ounce Royal Arms, 10-ounce Little John, and 10-ounce Merlin are all 4 nines fine. And we have a very limited quantity. Again, they're just $2.99 over spot per ounce while supplies last. Next, backdated 1-ounce gold Canadian maples are only $69.99 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.